The government and the Life Insurance Corporation have finally taken the first step of selling their stake in the IDBI Bank to a strategic investor. But the big question is, at what price the government is willing to part with its stake? Is the time right when the bank is witnessing a turnaround in its operation? Will LIC get back its money or make a profit on its investment, as it has bought the IDBI stake at a much higher price than the current market price? Let's check up on these relevant questions. Any buyer knows the compulsion of government and the LIC to sell their stake. Government is in urgent need of money and also doesn't have enough funds to recapitalize the banks. LIC has regulatory reasons, as both IRDA and RBI limits the holding at 15% and 10% respectively in the present case. Big players like Adani's, Piramal, Shriram, India Bulls and many other NBFCs are keen to acquire a bank with a network to enter and expand their presence in the financial services. Government and LIC have to tread very carefully when negotiating a price or valuing the bank. Government and LIC together have close to 95% equity in the Mumbai headquartered bank. It is easier to strike a deal for a large stake at a better price. The buyer also has to deal only with two stakeholders. LIC is currently the promoter of the bank with the management control. The insurance giant has 49% stake and the government with 45% is the co-promoter. Valuing IDBI Bank, which was earlier a development finance institution, is the key in the current stake sale. Banks, NBFCs and lending institutions are valued based on multiple of their price to book. Banks like Kotak and HDFC banks are valued anywhere between 4 to 6 times the book in the stock market. IDBI Bank, which is also listed in the stock market, has a very low price to book value of 1.14 times. If one looks at the market capitalization, IDBI Bank's valuation is around rupees 40,000 crore, which is too low given its large branch franchise, banking license and a brand equity. The valuation has to be forward-looking, as the bank is at the cusp of a transformation. NPA cleanup is almost done with huge provisioning in the books. The bank is now a consumer bank with retail assets like home loan and other consumer loan at over 60%. The legacy corporate loan book is also insignificant today. The bank is also out of the RBI's prompt corrective framework or the weak bank tag. The bank's financials or the numbers are also looking good. It has turned profitable for the first time in the last 5 years. The bank's CASA or the low-cost deposit are also at 50%, which is amongst the best in the industry. The bank has a balance sheet size of close to rupees 3 lakh crore and a loan book of rupees 1.28 lakh crore. If one adjusts the 22% gross NPAs, the quality loan book is around rupees 1 lakh crore. Loan book is one of the parameters for discovering the bank's valuation. The valuation should also look at the synergies between the IDBI Bank and the LIC. LIC is not completely exiting the bank in the immediate future. In fact, LIC and IDBI Bank could continue exploring synergies, as it would benefit both getting more business and better services. Last but not the least, LIC should get its money back that it had invested from the policyholders' account. LIC has paid an average price of rupees 55 per share to acquire the majority stake in the bank, but the current market price is at rupees 38 per share, which is down by 30%. The sale price should take into account the turnaround in bank's operation, a new business model of consumer banking, LIC IDBI combo to exploit the synergies for cross-selling, and finally a control premium for acquiring a banking license. Both the government and the LIC have to structure the deal right to get the best price up front and also further unlocking post the new buyer takes over and scales up the operations.